Good morning, everybody. Welcome to the Short-Term Show special episode series on Branson, Missouri, where we are doing a 10-episode deep dive on how to buy a short-term rental in Branson. So we've got a few supplemental materials for y'all in addition to the content on this podcast over on our website. So any questions you have about purchase prices and searching properties, you can do that on our website. And we also have the AirDNA data, thanks to our friends over at AirDNA, income data on properties in Branson. So you can find these things at theshorttermshop.com. So www.theshorttermshop.com, purchase prices and income data. If you want to buy a short-term rental property with a short-term shop agent in Branson, you can email us at agents@theshorttermshop.com. Or if you just like us, you just want to hang out with us more, there's a few ways you can do that. You can join our Facebook group. It's the same title as my book. It's called Short-Term Rental, Long-Term Wealth. We're over there talking about short-term rental investing all day, every day. Or if you prefer to talk to us in person or virtual person, you can join our Zoom call that we have every Thursday. You can sign up for that at strquestions.com. We'll catch you guys over there. Hey guys, welcome back to another Short-Term Show special episode series episode on Branson. Today we're talking about financing, which is a little bit interesting in the Branson market because you would think that you are buying cabins, but as we've discussed in previous episodes, a lot of those, even if they are single family like looking cabins, they are usually detached condos, which will require some special financing. So I've got a great panel here to talk about this. Bill, I'll let you introduce yourself first, even though everyone is familiar with you at this point. Go ahead.
My name is Bill. I moved to Branson in 2020. I used to work for Evolve as a home buying consultant nationally. So I help people buy vacation rental investment properties all over the country. That's where I met Avery. I just joined the short-term shop a couple weeks ago, and I primarily work with people in this short-term rental second home space.
Awesome. And next we have Lynette Van Gundy. Lynette, you want to introduce yourself?
Yes, good morning. I'm Lynette Van Gundy, and I work with Simmons Bank in the Taney and Stone County, Missouri area.
Awesome. Thank you so much for coming on. So since you're here, we don't have to continue saying, oh, I'm not a licensed loan officer, I can't answer that. So you get to be that licensed loan officer to answer the questions for us.
Okay, I'll do my best.
All right. So first, let's just do a few definitions for people who might not be familiar with the different types of loans and why you have to get this specific type of loan for condos. So conventional loans, typically for those of you who aren't aware, which most of you probably are if you've made it as far into this series as you are, a conventional loan, you can find those at any bank, mortgage broker, credit union, anywhere in the country. And those types of loans are Fannie Mae and Freddie Mac backed usually. And so there's a lot of guidelines on those, but those types of loans, they are using your debt to income ratio to qualify you for the property. Your credit score is a big part of that. And you can only get them in your personal name. Can't get them in an LLC or anything like that. There's a few types of conventional loans that people use when it comes to short-term and vacation rentals. Typically, an investment loan is probably the way to go. And a lot of people mistakenly think that the minimum percent down you can put on an investment loan is 20 or 25%. It's actually 15%. It just depends on where you're getting the loan and what the rules are at that particular company, but you can put down 15% on a conventional investment loan. What else on conventional? You can only have 10 finance properties when it comes to conventional. So you can have 10 in your personal name. If you're married and you can each qualify for 10 homes on your own, you can each have 10, but keep in mind, if you are putting both of your names on every property, you can only have 10 collectively. The other type of loan, conventional loan that people use a lot is a vacation home loan. And those are great because you only have to put 10% down, but there are some rules around that. So the primary intent for those types of loans is you have to be using the property as a vacation home, and you're welcome to rent it out to make money when you're not using it. But it does have to be something that you are using yourself. So I want everybody to be very careful with those types of loans. And we're going to talk more about this in a minute, but making sure that you're following the rules about that. If you are running spreadsheets on it, running cash on cash return scenarios, you probably need to just go ahead and put that extra 5 to 10% down to make it a true investment loan, to make sure that you are following the rules. There's a lot of people out there that try to get real cute about the rules, and I don't want anyone who ever gets in trouble to be anyone who has listened to our podcast. So when it comes to vacation home loans, they're really, really great. It is nice to only have to put down 10%, but keep in mind, it does have to be a vacation home. And there's some other stipulations around that too. Another type of loan is a DSCR loan, and DSCR it stands for debt service coverage ratio. This is like the second most common type that we see people getting for short terms. It's a portfolio loan, so it's not a Fannie Mae, Freddie Mac. You can't get these everywhere. There's a handful of lenders in the country who will do it when it comes to short-term rentals. But basically, they do look at your credit score, but they're no longer looking at your debt to income ratio. They're looking at what the property will make. So DSCR stands for debt service coverage ratio. Your debt service is your mortgage, and they want to see that the property is going to make the same amount of money or more than what that mortgage is per month, expressed as a ratio. Usually it's 1-to-1. Sometimes it's a little higher, but they want to see that the property is going to make enough money to be able to cover the mortgage. Now, they're not looking at your debt to income. You can get this straight in your LLC. You don't have to get it in your personal name. And there's not a limit on the number of finance properties you can have. So it sounds really, really great there. I mean, it is really great. Didn't mean to make it sound like it's not, but there are some things that you need to be aware of. So this is a really great type of loan for maybe if you are switching from a W-2 job to a 1099 job and you don't have 2 years of income to show to get a conventional loan. It's also great if maybe you're out of DTI, maybe you're too close on your debt to income ratio for a conventional loan, but you've got a down payment ready to go. And, or maybe you're out of conventional loans. So it can be a really great product. Typically, it's going to be 20% down. And the downsides, the interest rate's going to be higher than a conventional loan because it's a risky loan for the bank to give you because they're just betting on you, on your ability to manage it well enough to make that mortgage payment every month. A lot of them also have prepayment penalties of 5-ish years. Not all of them. Some of them have different ranges. So you want to keep that in mind. But those are the two main types of loans that we see getting done for short-term rentals. So conventional and DSCR. So now we're going to get into, now that we've given you a few vocabulary words, a little quick primer, we're going to get into the specifics of Branson because condos, specifically non-warrantable condos, can be a little difficult to finance. So I'll let Bill take it from here on that, and then we'll ask Lynette some questions about the financing side of it.
Oh, thank you, Avery. I love that intro. I just learned some things. Pet peeve is when people say DSCR too. It's like, no, it's not that. One of the biggest things people need to know when they are looking to buy something at Branson is we have different lending rules here. And this is something that when I was very new, I just figured, okay, it's just whatever this non-warrantable thing is, it's these banks making up their own like rules. But then the more I kept running into it and seeing it come up again and again and again, I realized this is something that is like very, very important to be aware of. So with non-warrantable, I'm sure Lynette can do a way better explanation of like specifically what it means. But in my opinion, it just basically means with traditional lending, they put it out on the secondary market, like with Fannie Mae, and then those mortgage bodies, they're not going to buy these loans from banks if they don't fit certain criteria. And when there's a lot of our vacation properties here in Branson are in these communities, well, because of the zoning, it forces everyone to buy in these communities that are all doing the same thing, which in this case is everyone's an investor. So certain thresholds get hit as far as the number of people go in the community. And that's one of the questions on what's called the condo questionnaire. So I know we're getting into the guts of it, but fundamentally, this is something that like you need to get with a bank that knows that they can work with a non-warrantable condo. That's the first thing I'm going to ask. because I have been in nightmare situations where the bank that the client has brought to buy in Branson is 2 days away from closing, and we're getting questions about, hey, we still are waiting on the master insurance policy because we're not sure that they have enough coverage on the building. And it's like, wait, why is this coming out now? We've passed our loan deadline in the contract. So like, why? You just told me the buyer's good, they're clear, but you're saying the association that they're buying in is not. And then it becomes they don't have enough coverage, so sorry, we can't do the loan. And then you're like, what? And this is like one of these things that they don't bring up until they discover it. So this whole condo questionnaire is initiated when the bank is trying to vet out this, I guess, third party as part of the transaction, which is the association. So asking things about, the budget, if there's a certain level of reserves that aren't there, that could be a huge issue. If anyone's got a lawsuit against the association, obviously that's risky. So fundamentally, like, that is why our banks are wanting to push most people into a commercial type product. And then also Simmons has this product that I've had a number of investors and people that, are from Kansas City, St. Louis, they come out, visit however many weeks a year, and they'll come out here and, also rent it on the side. So this has been a really good option for anyone. So they can avoid that headache, because that is by far the worst deal stress you will ever experience ever, is when you're at the finish line and your money is held hostage. And that's something that I've had at least half a dozen times happen. And it's not a fun experience. It gets me real fired up. And I mean, I start cursing like a pirate.
So Lynette, it would be super helpful if you would kind of give us a rundown on what it takes for a lender who, maybe it's a lender out of area, when they see a condo building or a condo development and a buyer says, hey, I want to buy something here. What's the process that a lender has to go through to find out if something is warrantable or non-warrantable? Because I think a lot of buyers mistakenly think that lenders should just know this. You should just be able to tell by looking at it, and you can't. So what's the process that someone has to go through to find that out?
Well, generally when we run into trouble is when we get the appraisal back. And most all of the units in the Branson area are non-warrantable. And from what I understand, that definition can vary from bank to bank. But Fannie Mae and Freddie Mac will not purchase these products because they feel like they're a higher risk item. So some of the things that can come into play with that non-warrantable definition is new construction. That's usually a red flag. The developer cannot be in control of the association. One thing that I think the main thing for Fannie Mae and Freddie Mac, reason why they won't buy them is because there are short-term rentals in that community. They have a specific limit of, the number of units that have to be owner occupied. And all of these numbers are in the appraisal. When it comes in, the appraiser addresses all of those issues. So when the appraisal comes in and they start reviewing the appraisal, they go, oh no, this, we can't do this. And as a lender, especially I grew up in small banks and now with this big institution, but as a local lender that many of these borrowers might be trying to work with, many of them, if they're not in the Branson area, they may not have ever heard of a non-warranted condo. So they don't even know it's an option until they get the appraisal and someone says, oh, we can't do this. So, it does vary a little bit. I did just find out yesterday, one thing that was really helpful is the Department of Housing and Urban Development actually has a list of FHA and VA approved condominiums. You can go right on their website, and I just was playing with it yesterday and put in Stone County, Missouri and Taney County, Missouri, and I found one that was approved, on their list. And what Bill and I run into sometimes is people that aren't in the area, their bank at home is saying, oh yeah, we can do this, no problem. Until, they get the appraisal in and then someone says, this is an issue. We do have some specific association requirements that we look at. We do require that 51% of the units be sold and conveyed. The owners must be in control of that homeowners association. The amenities have to be complete and installed. There can be no additional phasing going on, not a lot of construction going on in the project. And also, part of our questionnaire is if there's any type of litigation with the association or the developer. So that's kind of the specific things that we look at.
Okay. And so this is kind of where we jump into the why it's good to use a local lender argument, because sometimes and I've done it myself when I was new and I didn't know, tried to buy a condo in Panama City and in Florida, and it was non-warrantable, of course, as none of them in that area are warrantable. And I just went to my regular lender in Nashville and said, "Hey, can I buy this condo?" And she said, "Yeah, it may be non-warrantable, but we'll see what we can do." And then what happens is you get 3 weeks into the deal and the lender thinks they may be able to bang it through, because all lenders think that. Like, everybody wants to do the deal, right? There's nothing wrong with that. Everybody wants to be able to serve their client the best they can and get the deal done. So of course, everyone is going to say, "Well, let me try it." But what happens is you get
I've heard that so many times.
Yes.
I had to vocalize it. I was like, yes.
Yes. Yeah, let me just see. Yeah. Let me just see if we can do it. And what happens is you get 3 weeks into the deal, everybody's like ready to close because you're getting close to closing, and they get that appraisal back and they see these things and they say, "Oh no, we can't lend on it because it's non-warrantable." They take it to their higher ups and try to get it banged through, and they say, "No, it's non-warrantable because of X, Y, and Z, and we can't do it." So guys, by having this entire conversation, we're trying to prevent you from going down that road and being very sad at the end of your deal.
I've had DSCR lenders too that,
really?
Yes, where they're like, "No, we're good. We work with non-warrantables. This is fine."
Oh,
and
really?
then they still are like, "Well, I don't want to say this for every DSCR lender." So when someone's listening out there, like, that's an exception to the rule. Like Lynette said, every bank's different. This is why it's so hard to tell someone, yes, for certain that's not going to work, or it will, because I've had DSCR lenders say, "Yeah, they didn't have enough reserves in their budget based upon the documents that we received," which I believe is a 10%. "And we're pegging that to Fannie Mae standards." And you're like, "Okay, but you said this doesn't work for non-warrantable, right? Like, so what's the big deal?" And they're like, "Yeah, well, I'm trying to send it up the chain and my boss is saying we can't do it." And you're like, "What the heck?" Like, the whole point was, and then it just puts this, and this is, I've had multiple DSCR lenders. And another one was, again, with that insurance situation where they're like, "Well, this master policy only covers for," it was a 6-unit building, and it said it only covered it for like 700,000. They're like, "Well, if you math up the values of each of these now, because everything's going up to up to 200,000 or so, the value of this building is like 1.2 million. So there's this insurance gap that we're not covered, and we need that to be increased. Otherwise, we're not going to do the loan." And you're like, all this stuff that like I would never know. Like, this is totally curveballs out of left field. I'm just a real estate agent. Like, I don't know these the rules behind the scenes. So that's why I'm bringing these stories out, because this is like totally real. And then you get people upset. The title company's mad. The seller's like livid. The other agent is like, "What the Bill? I can't." And you're just like, "We're good, man. I think just hold it tight." And then you got to do this, like, "Okay, we might need another bank to come in. Ring, ring, ring. Hey, Lynette, how's it going? How many times have I done that, Lynette?"
More than once.
Yes. So this just, I bring that passionate statement because it's like, this is by far one of the worst landmines you can step on when you're buying something in Branson, because it's totally avoidable. You can just say, let's just not even like go in that dangerous territory where there's risk. Let's just go down this road that we know that's good. And people just are like, they don't listen. They just flat out don't listen. They're like, "Well, I've got a guy I like or a girl I like." It's like, I don't care if you like them. Like, do you want to go blow your leg off in this minefield? Like, come on. Like, let's just not do that. Let's just go with someone that you're going to be friends with for a little bit. And then guess what? How often do you talk to your banker, right? Like, you do a deal with them, but then maybe talk to them once a year. Anyway.
Yeah. You know what I think it is? I think people don't, like, if they've used somebody recently, they don't want to have to send all their documents to somebody new because it's a pain. But it is, when it comes to non-warrantable condos, you really do have to use a local lender, or at least, at the very least, a lender who has done a lot of deals in that market of the non-warrantable condo asset class. There's a few of them that are like regional that might not be local in some of the markets that we work in. But anyway, so
I also want to throw in there too, like the interest rate shopping has hurt me a lot because the people find these secondary market banks that are using a different product that isn't what's going to be able to purchase something here. They get this little seed planted in their mind, like this is kind of what the range of the cost to borrow is, and then they find out like the rates are adjustable, or they're going to be, we can get into that here in a second, but like that definitely is something that's also like a little bit striking, because people will shop rates, find that out prior to what actually works in Branson, use that as like, this is the basis for what I think, what the value is for rates here. And then they find out rates locally and they're like, oh, what the heck? Like, and then it's always something that shocks people. And I like to get that out there because it's like, well, that was never going to work in the first place. So don't compare apples to oranges. So,
yeah. Well, and that happens a lot because like the big national lenders, like your Rocket Mortgages and your Lending Trees and things, if you start looking at loan options online, you're going to start getting all these targeted ads from them. And I've actually gone through the process with one or two of them in my buying career, and they will quote you something super low. It seems really low compared to everything else. And then I've seen it also blow up. I'm not saying they can't close deals or anything, but it is a completely different beast. And it's typically what the main bread and butter of those types of companies are: primary homes. So they're going to catch a few investors here and there in their net that they're casting, but the primary home market and lending is completely different. And I think that's where people can get a little put off, because these big, huge banks are advertising these super low rates, but it's for primary homes, which is a completely different product, and people get a little confused. But so Lynette, I want to hear from you now about the products that you guys offer and what the loan process looks like with you guys, because it seems like, I haven't bought anything in Branson, but it seems like you guys are, since you're local, you already know by just looking at the address of the property what you can do and what you can't, because you do these every day.
Well, and we do maintain a list of condo associations as we work with them. We do maintain a list with some contact information, because you do have to have the association contact information. You have to know, like Bill mentioned, that master policy. You have to know who carries that. So we do kind of, try to maintain a list. So when someone calls and says, hey, can you do this? We can look quickly and see if we can do it. The main issue we run into in our area is new development. And there is a lot of new development going on, in the Branson area. And, with our requirements on that, the 51% of the units, being sold and conveyed, the phasing being completed, the association turned over, that usually when we're talking about new construction, those are issues, for us. But, and one thing I did want to mention on our previous conversation, when you're talking with those realtors or those borrowers that are wanting to finance, outside of the area, tell them, ask your lender, is this an in-house product, or are you planning on selling this to, Freddie or Fannie? Because if they're planning on selling it, it's guaranteed it's going to blow up at the end.
That's a great point. Great point. I've had people bring lenders from out of town that did say, don't worry, it's a portfolio loan. Mm-hmm. Keeping it in-house, just like Lynette said, and it ends up being okay. I'm still a little nervous because I'm like, I never know what they're actually doing behind the scenes, because bankers aren't telling real estate agents, like, here's the secrets of what we're doing behind the scenes. They just say things like, oh, the underwriter's saying this or doing that. And you're like, okay, cool. I know I'm not the client. I don't have the privilege to like see what's going on behind the scenes yet. We're all kind of in this car together. So anyway.
So primarily, to go back to your question, Avery, generally, I have the initial contact, with the borrower, discuss, if we're truly talking about, a consumer purpose, primary or secondary home, and what falls into that secondary home. definition, Simmons Bank does offer those DSCR loans, through our commercial loan department, do a lot of referrals, back to them if, what I offer doesn't fit what they're looking to do. We have an online, every lender in Simmons Bank has an online pre-qual application. Send them, that link for the pre-qualification. We check credit, based on the information that they've provided to us. We're able to, provide them with a pre-qual letter. Most of the realtors, Bill, I think in this area, they want a pre-qual letter before they'll start, really working, with someone wanting to buy. So we try to get that, quickly, usually within 24 hours, we can get that, out to them. And then, when they find the one, they get the contract, then, we go back to them and start getting the documentation items and, verifying that, it is going to for sure work. And we can usually close a deal within 30 to 45 days, depending on the appraisal, turnaround time. Right now, it's pretty reasonable. We did back in the peak, it took 3 weeks to get an appraisal. So, that slowed down our closing times. But right now we're turning them pretty fast.
Would you be able to go into like things like term length and like, fixed versus adjustable, and then PMI being included or not included?
Sure.
And like how many can you do? Like those things?
Yeah. Let's hear about all that.
Well, for a condominium in our area, we have a 30-year fixed rate product, or we have a 15-year fixed rate product. Those are strictly for condos. That's all they're for. And they price according to down payment and credit score. The minimum down payment is 10.01%. And we do not require mortgage insurance on that. Since we're under the 90%, we don't have to require the mortgage insurance. There is a little bit of a pricing break if you do put down 20%. And then on our portfolio products, and we also have adjustable rate mortgages. We offer a 7/1 ARM or a 5/1 ARM. They're 30-year mortgages. Again, same 10.01% down payment. And then a break in the rate at 20% down payment. And again, those do not require private mortgage insurance with the minimum down.
What does the debt to income need to look like to qualify for these?
Generally, between 42 and 45%, with 45% being the max. We do have a few criteria. If you meet these criteria, we can go up to 50%. But generally we like to see them under 45% on their debt to income, which means, we're just strictly looking at their personal income, no income on the unit itself, which you mentioned with the DSCR. A lot of people want to throw that in there. They want to say, well, I'm going to be renting it this many, days out of, the month, and I'll have this much income. But on, consumer residential side, we cannot take that into consideration at all.
Gotcha. And I know you can't quote specifically because it's going to be different for each borrower depending on their credit score, but what are you guys seeing for interest rates at the moment? And keep in mind, people might be listening to this a year from now, so we will do a quarterly update on this at the end of the series, but as of right now, we're in late spring 2023.
Okay. Well, and again, like you mentioned, rates are very subject to, down payment and the credit score, especially. Our best pricing is with a credit score of 740 or better. And we have several tiers, down through there with a minimum of 640. Generally with the best score, right now our 30-year fixed is over 9%. So that's chunky right now. We're seeing most people go with an adjustable rate mortgage on a second home. Those are going to be in the low 8s right now.
And then also that's no PMI in there too, because I've had people where they do that in addition to it when they're trying to do their numbers, and it's like, well, that's not accurate. So whatever that conversion to interest rate being factored in or not is something people need to be aware of. So
And the rate market is just, it's the highest I've seen it for years and years. Right now with the, 2 years ago, we were doing these things in the 3%. So it's a real rate shock for a lot of folks right now.
Mm-hmm. Well, I think we're all a little traumatized from the real estate market 2 years ago.
Yeah.
Yeah, getting beat to death, but we made it through. We all made it through. But the rates were it was great that the rates were so low, but man, was it rough, like getting completely trampled as an agent and as lenders. So many people, but we're grateful for it. Of course, I do like it a little bit slower and more manageable. I have to admit, you can actually hear yourself think and make sure you're missing anything.
Yeah. I get to analyze more versus just being reactionary and almost like someone fending off the zombies on the castle wall with a stick, just hitting one thing that's in front of me after another. And now that that's kind of no longer the environment we're in, it's in more in-depth analysis and looking at what these properties are going to do for the people that are interested in getting them. So,
yeah. Well, what have we not touched on in terms of financing in the Branson market that we probably should? Do you get into many jumbo loans in Branson? There's not, I think most of the inventory is below the jumbo limit, but do we do many jumbo properties in Branson?
I don't see many. No, yeah. I mean, our pricing goes up to a loan amount of $750,000. We do have pricing above that, but on our in-house products, generally, I can't think of any that I've done over that amount right now.
Which I think is awesome, because a lot of our listeners are used to buying in the Smokies or in the Florida Panhandle where everything is over $1 million. Well, Florida Panhandle, Smokies, not everything is over $1 million, but most things are over the jumbo limit. So I think it'll be really refreshing for a lot of listeners to say, oh man, there's a place I can go that nothing is over the jumbo limit.
Yeah. Nice. Yeah. This is, again, this market is unique in that where our property values sit, it's if someone is, not to say that this is just a budget friendly first timer market, because this is something that we do have larger options, but as far as off the shelf, something for the $200,000 to $300,000 price range, it's we have that here. And, if people are really getting into the numbers and they're I'm not getting 15,000 in cash flow a month. You're well, that's never going to happen. How did you ever get that expectation, please? So it's a reasonable, hey, you're not going to be uber wealthy by picking up a 2-bedroom condo in Branson, but it's definitely not a bad thing. This is a blue chip market. This is a safe area where I'd bet, hey, you want to go buy your comparative property on some random lake with a residential loan where you may not have any operational security in terms of your on the ground team because no one lives out there and there's no tourism industry there. It's go right ahead. If that's the risk, you want more upside. I mean, this is what it is. So.
Yep. I agree with that. I personally don't like trailblazing into markets where it's not something that's typically done. I don't want to have to work so hard to find cleaners. I want cleaners that already know what they're doing because they've done 100 other vacation rentals. But I just want ease and minimal crap to have to deal with and set up at this point in my investing career. But other people want to trailblaze. That's great. I don't have the energy for that anymore. I'm turning 35 on Friday. So I don't have the energy for all that craziness. So anyway, what else are we missing? What else do we think the listeners could benefit from hearing about financing in the Branson market?
How many second home loans can you do here, Lynette?
Well, one of the things with us is with primary and secondary residences, they have to be 50 miles apart. So, I mean, you can have a true investment property and still buy a second home, in Branson, but you're going to have tax returns to support that other unit is an investment. And then, we can't do, 2 second homes within 50 miles of one another. So that, we're pretty much limited to, the one primary or secondary residence. If they have more than that, then they're probably, looking for one of those DSCR loans.
Gotcha. Awesome. Well,
I don't think I guess one thing to point out too is I just want to I don't want to sound like I'm being a dead horse with the non-warrantable headache. It's just, I don't want
Sound
people
like
to be,
you've been through it. with the
yeah, like you want to talk about triggered, like let's talk about lending problems with people's as a realtor in Branson for this particular thing that we do. So it is one of these that, again, there's no guarantee. I can't ever say for certain someone's bank is not going to work. It's just, I do know what does work. And, Lynette, Simmons Bank, handful of other banks locally have never let me down. So it's like, why would you go ahead and try to force it just to get another, tenth of a interest rate point off on your price, right? And people are shopping for that. So it's just give them the heads up. And this is something that, because of the zoning, I will repeat it, that is what created this non-warrantable thing. It's not like it's this dangerous, awful thing. It's just more of because our areas put all of these people in these same communities, this is what's created this other complication. But beyond that, I mean, the zoning and the banking for Branson, that's like 90% of it. So if someone is like, cool, I'm good with that, we can do a deal and make it a really, really pleasant way to get started.
Awesome.
Yeah, we do a lot of lending for people out of state, and with the computer age and the online applications and the secure file transfers, it's very easy to do things, for people and never see them. I mean, I probably don't ever physically see 90% of the people that, I help. It's a very, very user-friendly, process. The title companies in the area are awesome. They do the closings by mail. So it just, everybody's kind of designed in the area to make this as painless as possible for the buyers that want to come, to our area.
Awesome. Well, thank you guys so much for your time. I really, really appreciate it. Lynette, if any of the listeners are interested in buying in Branson and they liked your lending vibe, how can they get a hold of you?
Best way to get a hold of me is through my email, which is it's Lynette.vangundy@simmonsbank.com.
We'll make sure to put that in the show notes too, so people can see it.
I'm not terribly busy. I am the second lender in this market. So Honor McGuffey also works in this market, and she kind of brought me over. I was a commercial lender, so I know a little bit about those DSCR loans that you're talking about. And Honor brought me over here to work with her a couple years ago. So I've still got the time and looking for the contacts. So I'm happy to talk to anybody about anything we need to discuss.
All right. Well, thanks so much. And guys, if you want to buy a condo with Bill in Branson, you can email us at agents@theshorttermshop.com and we'll get you connected. And if you just have further questions and you want to learn more about this, you can join our Facebook group. It's called Short-Term Rental, Long-Term Wealth, same title as my book. Or we have every Thursday, open office hours Zoom where you can come ask us any questions that you have. You can sign up for that at strquestions.com.